human nature doesn't really change, right? Like regulations change, government systems change, even religions change, right? The things change over time, but like our fundamental nature as people doesn't really change. And that is why these things keep happening, because greed, ambition, and I'm going to make an off-color comment, but men's desire to impress women will never change, right? So we are driven by the same primal forces that Roman aristocrats in 33 AD were driven by, and that these bankers in 1866 were driven by, which is always, how can I do more? How can I create money, make more money in a riskier fashion, right? And it often involves debt.
Monaco 64, home of alternative economics and contrarian views. Well, today I have the pleasure of speaking with Arie van Gemeren again. We spoke about a month ago. Arie is into real assets. He has a real estate company, but he also has now a great YouTube channel, in my opinion. It's only got a few thousand subscribers, but I think it should have a lot more. It's called The Timeless Investor. So Arie, welcome back to the channel.
Thank you for having me, Mario. And my few thousand investors, I think, are somewhat due to you for my understand a shout out a few days ago. So thank you. And thank you to your followers that also chose to follow me. Thank you. I appreciate it.
You're welcome. I mean, when I see good content, I feel like I have to tell my viewers about it. And yeah, there was a video in there that I want to talk about today, Arie, the one about the 1866 banking crisis in London, the city of London, over in Gurney and Company. And I think it's a good way of looking back at history to realize that a banking crisis could evolve, like could happen in just under 24 hours. I mean,
Yeah.
it can happen so quickly. So maybe if you give us a background on that crisis, and then we can proceed after that.
Yeah. Well, I think I like the what I like to do when I do these historic studies is, what are the timeless principles that undergird kind of what happened, right? Because what happened over in Gurney and Co. is not is it happens repeatedly. And actually, as I was studying it, I was shocked by the number of parallels between '08 and 1866, right? They're very, very similar kind of evolution of events, right? And like everything, and what was fascinating with this story is the notion that you can ride the conservative reputation of a company sort of into the ground, which we sort of saw again, and I'm going to reference '08 a lot. We saw again with Lehman, with Bear Stearns. I mean, these were very venerable Wall Street firms that collapsed sort of overnight. And there's like, we just released another one about the crisis of 33 AD as well, right? Like this massive Roman banking crisis that also happened at the time, different time period. But the similarities in the events are marked, right? Like there's so many timeless parallels over history. And one of the recurring thematics I've really been hitting on is like human nature doesn't really change, right? Like regulations change, government systems change, even religions change, right? The things change over time, but like our fundamental nature as people doesn't really change. And that is why these things keep happening, because greed, ambition, and I'm going to make an off-color comment, but men's desire to impress women will never change, right? So we are driven by the same primal forces that Roman aristocrats in 33 AD were driven by, and that these bankers in 1866 were driven by, which is always, how can I do more? How can I create money, make more money in a riskier fashion, right? And it often involves debt. And so the Ober and Gurney story is fascinating. And again, it's fascinating for the '08 parallels. So the firm had historically existed as a discount shop, managing, trade between India and Britain, for example, and taking 3% clips. And it was a very conservative, very steady, very simple business, but made a lot of money. It's one of the largest banks. It was known as the Corner House. They'd actually bailed the Bank of England out. They were the big dog, right? Like the venerable London firm. And the new breed of partners that came in after the old man passed, Sam Gurney passed, and the new partners took over, again, sort of a timeless principle, they got bored of making money the conservative way. And they started thinking, like, how, instead of making 3%, what if we made 15%? And started investing firm capital into not great projects, right? But the reputation continued that they were a blue chip, very solid, firm bank, and they were able to ride that for quite a while. And like with so many of these things, it was a catalyst elsewhere in the system that sort of sparked the concern. So a different firm went under, and that sort of sparked a run and concern, and then suddenly everybody was concerned, and then Ober and Gurney came under the spotlight. And what I thought was really crazy about this story, and this is a little bit of an argument for regulation. I realize there's mixed views on this, but in my opinion, with banking and banking becoming more and more systemically important, there needs to be some sort of a check on the system, or else they can cause cataclysmic issues, right? And frankly, I don't think we've really solved any of those. Like an '08 happened, and we still have an even more robust in a negative way, larger and crazier banking system today. And shadow banking has really taken off, right? So there's, I mean, not to ramble too much, but the human impetus to find profit will always find a way around regulation, which is sort of an argument against regulation. People will find a way, right? And so what was interesting with Over and Gurney is the partners recognized they were in trouble at some point, and they actually did a public stock offering, and they didn't disclose any of these bad loans they made. And they bilked the public of quite a bit of money, and it was completely legal at the time. So, like today, if you tried to do the same thing, you would get in a lot of trouble. But everything they did was technically legal, even though their prospectus didn't disclose any of these problems they had. And so, when the run started, the partners went to the Bank of England and said, "We need £4 million." And I don't know the conversion, but £4 million in 1866 is a lot of money. And the Bank of England said no. And they had to post a sign saying, "Due to a run on the bank, we're out." And it was a systemic shock. I mean, you had the corner house, the preeminent London bank went under, and it dragged a bunch of other banks down, and it created this financial contagion. And what's interesting, somebody asked me on the channel, they said, "What did the Bank of England have to eventually step in, just like the Fed had to eventually step in '08?" And the answer is yes. After they had allowed Over and Gurney to fail, they did eventually have to step in to stabilize and protect the market, which leads to the question, ought they have bailed Over and Gurney out in the first place to prevent the further run that came? And it leads us to this whole moral hazard question that we deal with today, which is, I mean, I think the answer is no, they shouldn't have, but then they did eventually have to step in. So what ends up being worse for people? I think both are bad. But it's a fascinating story, and it will continue to happen. And it's happening, it's happening today. It happened in '08. It's happened time and again. So it was an amazing read on human nature, and the 33 AD story that I mentioned as well is interesting as well, because it's sort of the same thing. Like Roman aristocrats over levered, they got massively levered, and the Emperor Tiberius brought back a Julius Caesar era law to require lenders to invest in Italian land. Well, the reality of that was everybody then had to sell, which froze credit markets and froze the system. And Tiberius ended up having to inject 100 million sesterces into the system to unfreeze the credit markets. So the fact that you have the same sort of dynamic playing out, and I'm sure between 33 AD and 1866 and 2008, there are many other examples of this happening as well. So it's a timeless pattern. And frankly, I don't know that regulation solves it.
Yeah, and you spoke in your video how it, the crisis just like appeared out of nowhere, and in 12 hours there was panic in the city of London, and yeah, it just goes to show how the markets and faith and confidence can turn on a dime, and it's the same thing that happened to like Silicon Valley Bank back in 2023. I think it was March.
Yep.
And nowadays, the run can be even quicker because you can just take your deposits out online, right? And I think
Yep.
that's what happened. A lot of even very wealthy people at Silicon Valley Bank took their money out. And one of the reasons, Ari, was because of this. The FDIC, they
Hmm.
report this unrealized losses on investments. And I mean, if we look here, 2023, it was already a problem 2022, but then people suddenly woke up and realized, are my deposits really safe?
Right.
And I think it was one of the reasons that it triggered that run. And what's a bit concerning is that these losses are still really huge if you compare even
Yeah.
to '08. Before we go further, maybe could you explain to the viewers what a discount house is? Yeah, and how it works. And I think the Federal Reserve was kind of a discount house. They only used to hold discount bills and gold when they started out.
Yeah. Well, in the specific case here, the example I gave in the article in the podcast is a merchant in India sends goods to England and they don't want to wait for payment. So Over and Gurney would pay them like 96 or 97 cents on the dollar. So they get their money today and then they would collect a 3 to 4% when the goods arrived. So it was a very simple, very safe business just to manage the cash flow for people on both sides of the trade equation, right? And that was the business, and they were the financier of that business, which is a very conservative, not risky business, not a lot of leverage involved. And then, as I mentioned, the junior partners were like, "This is boring. Let's go do something bigger. Let's make more money. Let's invest in Peruvian railways and the shipyard on the Thames." Which, by the way, I was educated tremendously by the British viewers on that video on all of my mispronunciation. Thames.
Oh
I
yeah,
think
you said Thames,
I
right?
said Thames, which is what it
Yeah.
looks like, but it's the
Well,
Thames.
yeah, you wouldn't know. I mean, yeah,
I wouldn't know, but now I know. And
yeah.
Walter Baggett is not
Badget.
Badgett. Thank you. And I said Bagaho, I think. So, anyways, thank you everyone for the
That's a
correction.
weird name anyway.
It is a weird one, but
And the other thing, your company is called Lombard Equities, isn't it?
Lombard Equities Group is.
And over in Gurney, the corner house was on Lombard
I saw
Street.
that. Amazing. Yeah, I saw that.
Did you know that before you?
No, no, I didn't know.
What
Yeah,
a
no.
coincidence.
Yeah, I'm from San Francisco, so originally it was named after Lombard Street in San Francisco,
Yeah,
which
there
is
is a Lombard Street, isn't there? In
yeah. So it's interesting the Silicon Valley Bank and First Republic thing. I mean, I was at a front seat row to that. So I banked with First Republic, as did many well-to-do Californians and people on the West Coast. I mean, they were like the preeminent bank for wealthy people. And not saying I'm a wealthy person, but like all of my investors and clients who are very wealthy all bank to First Republic or SVB or Chase, right? JP Morgan's a different story. But when SVB started to go down, I started to get WhatsApp messages and notifications from people in my network being like, something's happening, something's happening. I'm hearing really bad things. And they all started porting their money to First Republic because the two banks were sort of interchangeable. So they all started moving their money to First Republic, and then SVB went down pretty quickly. And I have a rule of thumb that if a bank CEO needs to come out and say the bank is good, then the bank is not good. There's a serious problem. The second that they have to say that, it's over. And the reason is like the system that we live in, they never have enough money to solve a bank run. So it is entirely trust dependent. You have to trust. If nobody pulls their money out, it's like somebody else mentioned the What a Wonderful Life, the scene where he's like, well, your money's in his farmland and your money's here, and if you all just don't ask for your money right now, we're fine. It's the same story with banking, right? And so the thing about runs happened to Over and Gurney, and it will continue happening, is the second trust gets punctured, everyone freaks out and they pull their money out, which is a self-reinforcing mechanism. And so every time this has ever happened, people try to do the It's a Wonderful Life thing, and it doesn't work because it's not a community bank with all these friends and family that have their money in. It's a global bank. And so the CEO comes out and goes, everything's good. And it's like, everyone's like, that's the sign. It's not good. I got to get out. So the second the First Republic CEO came out and said that, it was done. But what's interesting, and there's a lot of discussion around like the duration mismatch, right? Like the banks were investing in long dated treasuries. There's another 2008 parallel, which I think is really interesting. And this is a relatively controversial perspective in terms of like, I don't think everyone agrees with this. But when I was in equity research at Fisher Investments, the CEO of the firm had a perspective that '08 was really sparked by regulatory change, not over leverage, which is interesting because I think over leverage was a huge issue. But his argument was that all of these banks, Lehman, Bear, and everyone else, carried a bunch of asset backed securities, mortgage backed securities on a held to maturity basis. But a regulatory change was passed shortly before '08 really kicked off, FASB something, 10 or 12, I forget what exactly the number, that required them to hold even held to maturity and available for sale securities at mark to market pricing. So, despite the fact that, I mean, Lehman's business was fine, they had a short term credit squeeze that crushed them. The thing that killed them was having to market a bunch of securities that they had no intention to sell. And so they marked the prices down, which sparked panic, which sparked lack of trust. And then the system kind of blew up. And we know what happened as a result of that. So, same thing with, I like to look at these parallels, like same thing with Tiberius, right? Tiberius passed a regulation that sort of popped everything else that was going on and caused this bigger problem that blew up in Rome at the time. And then he had to step in and solve it. You could argue that the regulatory reporting changes sparked this realization that these banks were sitting on a bunch of securities that were technically on a illiquid, held to maturity basis, had lost their value. But did they really if the bank never intended to sell it? And so that, that was kind of the spur of it.
Yeah, and one thing I wanted to cover is shadow banking because you said that even back then over in Gurney and Company, they were kind of a shadow bank of their era. And there's a lot of talk about shadow banking, and we've seen recently a couple of companies. Well, one company, Tricolor Holdings,
Tricolor. Yep.
they went under, and then First Brands, they're in trouble, and they're part of this shadow banking. So, could you explain to us what that is and what, yeah, repercussions it could have on the whole system?
Well, my understanding of shadow banking is it's banking that exists outside the regulatory landscape. So, bridge debt lenders. I mean, one of the big things, and I'm a real estate person, so I see everything through real estate colors. But one of the things that I think led to the situation we're in now in real estate in particular is that in the aftermath of the GFC, you had the advent of a lot of these like bridge debt firms, right? And I'm not going to name any names. There's many big ones, and some of them are failing and some of them are doing fine, but they basically were making loans outside the purview of the regulatory environment. So it's banking that's a shadow of the real banking that exists outside the landscape. I don't know that Tricolor Holdings is necessarily a quote unquote shadow bank. I mean, what's interesting about that is they just did a bond offering with a AAA rating and they were underwritten by the big boys in the industry, and they all missed it. So the question that Tricolor really raises, and we can get into, I'd love to get. I mean, I just dropped a piece this morning about some very significant recession indicators that I'm seeing right now, economy wide. But it raises a question on how well are these firms underwriting risk, and more broadly, how systemic is it? So subprime auto loans are the second largest pool of loans in the United States behind mortgages. And if subprime auto loans are failing or banks are not underwriting the risk correctly, does that create systemic risk system wide? Because it's a massive, massive pool of money. And the fact that all the majors looked at Tricolor, gave it a AAA, put people in it, bought their bonds, and didn't catch this, and I forget the name of the other firm, but Tricolor was followed very closely by another subprime loan group also failing. So like with anything, it's like I mentioned with over in Gurney, it's like a small peripheral bank failed and that triggered a bunch of other stuff. I'm not saying we're rolling into that. I wouldn't be so audacious as to make that claim, but the point is like these are the kind of things that can lead to a systemic issue. And it raises questions like they clearly missed the boat on the underwriting on these deals, right? And like they just did a AAA bond offering and they were fully subscribed. So it's a big problem. I think it's a huge problem. And there's a bunch of other factors in the economy that are really underappreciated right now. Like very concerning factors that I think are predictive of a recession. And I'm not going to call a recession because prognostication has a way of blowing up in your face. But I think that the indicators are pretty clear that we're rolling into a recession, in my opinion.
Yeah, I guess, yeah, not shadow banking, tricolor, but it was more like the asset-backed securities market. And I think subprime auto loans are quite a, or auto loans in general, they're like 1.6 or 1.8 trillion, maybe even
Huge.
more. They're huge. And we remember, I mean, I remember Ben Bernanke saying that subprime mortgage crisis would not spill over. So
Right.
I
Exactly.
guess maybe he hasn't really done any historical study like about over and how things can really accelerate. So you said you've written something about some recession indicators.
Yeah.
Want to cover?
Yeah. Yeah. I'll just start. I'll do a share screen and kind of share some of the research I did. But let me start with the basic throughput here, which is I'm deeply immersed in the real economy. We own apartment complexes across the
Oh
West
yeah,
Coast.
can I forgot to say something.
Please.
Yeah, so to the viewers, yeah, Ari and I believe that real assets outside the banking system is really important. But the only difference between him and me is that he's more into real estate,
Cool.
which I think it's fine as well because it's something that is real and you can touch, you can live in, and as long as you don't leverage, you're fine. And I'm more of a like precious metals guy, so I just wanted to put that out there before
Yeah.
you go further.
Yeah, and there's a lot of advantages to precious metals, by the way. It's like I would argue real estate is much more exposed to the banking industry. I mean, precious metals are a hedge against all these things, and they have immense. I just had a discussion yesterday on LinkedIn. Somebody posted something about what happens if Bitcoin becomes the major currency of the world. What does that do to gold prices? And I said, what difference would it make if they don't fulfill the same function? I don't think Bitcoin will ever be the world currency. But second of all, gold is currently not the world currency. So why would something else becoming the world currency have any impact on gold? And one of the arguments I always make, additionally, in support of precious metal, is my wife is Iranian, so I have a lot of exposure to Middle Eastern and Far East cultures that ascribe a tremendous amount of cultural value to precious metal, and those cultures are not going to stop buying gold and precious metals in mass. It will never stop. I see like my in-laws hold wealth in gold, right? They have gold in their bank deposit boxes, and I mean, you cannot discount the value of that. Real estate does benefit a little bit from that because those same cultures are also very big buyers of real estate. There was a gentleman I knew years ago when I was at Goldman who was a Middle Eastern guy, and he was a very successful tech guy in the Bay Area, but he came to the States, and every dollar he made, he bought real estate. Now he happened to be buying in Santa Clara, which for the listeners that don't know, that is like the heart of Silicon Valley. So probably the most valuable real estate, some of the most valuable real estate in the world. Um, but I talked to him one time and he said, look, I make a lot of money from my tech business and I just buy real estate because my father always told me, buy real estate. That's what we do. That's how we operate. We just buy real estate. And so he made more money from his real estate than his tech business, which was great. It was awesome for him. And it was a cultural thing. And we cannot discount the value of like these massive percentage of humanity that ascribes tremendous cultural value to these asset classes. All that being said, real estate is much more interest rate sensitive and it is driven by debt. So it has a little more exposure than gold does. In my opinion, I think gold is safer in some respects.
I
Um,
guess the perfect thing would be to have, if you're into real estate, still have a little bit of gold because it's also more liquid, and
yes.
vice versa. I mean, and oh, you're talking about Iranian or Persian. I've got one of these. This is a Persian gold coin.
Oh, amazing. That's
It's
awesome.
got the Shah of Iran.
Yes, of course. Shaw. I can't, and those coins are given as gifts to my children every year. So they have
Yeah.
already collected a nice little hoard of gold coins as
Oh,
well,
that's
which
good.
yeah, that's amazing. So so thank you for that introduction. So in my business, I'm very exposed to the real economy. And I think we have a canary in the coal mine view of what's actually happening on the ground. So we have a right there view of, are residents struggling to pay rent? Are they late for rent? Do we have rising delinquency? What's happening with leasing operations? We get quick feedback on people have lost jobs, businesses are shuttering, things are happening. And for a year and a half, things have not felt well in the real economy to me. And it was interesting because this, and I am a very interest rate sensitive person, right? Because I'm in a very interest rate sensitive asset class where if rates go down, my values skyrocket. If they go up, we have a problem, right? Pros and cons to being in real estate. That's a big pro and con. And it was frustrating because what I was seeing was delinquency, late rent payments, struggles leasing, rent prices were kind of anemic. And I was hearing, being on the West Coast, about layoffs everywhere. Nike laying people off, Intel laying people off. Apple never laid people off. I think Apple's reputation is it doesn't really lay people off. But most big tech companies were laying people off, a ton of people. And yet the Bureau of Labor, I think the BLS, continued to release reports that showed really strong payroll growth. And I was like, this doesn't match what I'm seeing. And lo and behold, and here, let me share my screen.
Yeah, they revised the like by
Huge revision.
911,000 the payroll numbers from March last year to March this year.
Yep. Huge numbers. So this is a sneak peek for your subscribers. So this is a paid premium article that our Substack subscribers have to pay for access to, but you guys will have access here with Mario's channel. So this is a bit of data that I found really interesting. The percentage of renters paying late. So if you look at and this to me is indicative of there's some level of stress in the underlying economy, right? It is coming. I did some research on what are major national REITs reporting. They're not reporting an uptick in delinquency, but they are reporting an uptick in renters paying rent late, which to me is an indicator that there is some stress building, right? People paying rent late means they're struggling to make ends meet. It's getting more difficult. So this was the first kind of real world indicator. I'm going to come back to this. This is what I want to really point this out. So this is the original numbers for changes in jobs from the year before, and this is the revision. Okay, so this whole period, I kept saying the numbers don't feel right. They don't feel right, and then all of a sudden, they do this massive revision, which caused interest rates to drop and caused the Fed to basically say, "Oh, never mind. Now we're going to embark on a more dovish cycle and start cutting interest rates instead." So this was the first thing to me where I looked at this and I said, "Okay, there's something going on here that." Like this is what I've been seeing it, but it's nice that they're finally reporting the accurate data. Now, one of the questions, and now in this previous period, by the way, pre these revisions, there were many, many other revisions that were also revising previous job reports down. So these are the post-revision reports, but the numbers never lined up. And one of the really fascinating reasons why, surprising to me, a lot of the BLS job reports are driven by a model that they have put together that tries to estimate the number of new business starts and businesses failing in the underlying economy. And they don't have those actual numbers till later. So a lot of the reporting is driven by a model that tries to predict new business starts and new employees being hired and business failures. Well, that model was wrong over this period of time. So the model predicted higher job growth than reality eventually showed. So every time they would go back and revise, and I kept saying, why do they keep, and they keep announcing these rosy job numbers, and then, and buried in the text was downward revisions of prior job growth numbers. And the reason is they were overestimating business starts and underestimating business failures in the underlying economy, which meant that they kept having to revise job reports down. And then finally, we had this massive revision here recently, which was really, I think, the catalyst for Powell to say, okay, we need to do this. So this is pretty substantive. The other thing that's getting a lot of press right now is unemployment rates for recent college graduates. So I want to point this out. So this is the unemployment rate for young workers. These are the unemployment rates for recent college graduates. If you look at the line through here, I mean, we are recent college graduates are in a way worse position today than they were pre '08. And the question, and I'd throw it out to your audience too if they have any perspectives on it. The question is it AI or is it weakness of the underlying economy? Now, I graduated right here. Actually, I graduated right here, 2009, from the University of California at Davis. And it was hard to find a job then. It was really difficult. It wasn't because of AI, it was because the economy wasn't good. The question in my mind is this because businesses are tightening and they're not hiring, or is it because they've outsourced all this work to AI? And I don't know. I don't know what the answer is. I suspect it's the economy and it's not AI. That's my fundamental belief. But I do think I don't know if you have any thoughts on that, Mario, but
Yeah, I recently heard that I think it was the Bank of England governor saying that the same thing is happening here to young graduates. And I think it's really easy to say it's because of AI, but I think it's more because of the economy.
yeah,
I think a lot of the economic growth is more like deficit spending and government spending. And
yes,
these revisions as well. I think the model isn't great, but I think it's very political. They're trying to keep the numbers as high as possible, and then they revise it later and hope that no one notices it. But
yes,
you can
agreed.
only do that for so long. But I think it's nothing new, though. I remember when I graduated in the mid late 80s, I didn't get a job right away.
Yep.
So that's the other thing. Yeah.
Yeah, so these are to me, these are very concerning. I really want to talk about this. So I don't know how many people are acquainted with the leading economic indicators index. There's lagging indicators and leading indicators. So lagging indicators are things that I think I put no, I didn't. Okay, so there is a really nifty chart that shows lagging indicators on top of leading indicators. And what that chart shows is a very clear correlation that lagging indicators don't start reflecting what's going on in the underlying economy till much later. Leading indicators are indicators that indicate if we're headed for a recession. As you can see, the leading indicator series has routinely declined precipitously before we actually run into a recession. And a recession indicator just went off again on the LEI index. The LEI index has been negative, falling at this point for 38 out of the last 40 months. Historically speaking, that has never happened without a recession following. The LEI index takes into account 10 different components. Consumer expectations is a large one of it. Interesting, and new build permits. There's a couple indicators that are leading indicators of what is going to happen. One of the components of the LEI index is the US stock market, which is interesting. So the stock market is a leading indicator, but it is typically the last to fall. So the LEI index, and now you'll notice here we've had some false flags. The question here, again, Mario, is oftentimes we are in a recession before we realize we're in a recession because of the backdated nature of a lot of this data. And when the lagging indicator index catches up, suddenly everyone goes, "Oh, we've been in a recession," right? The stock market is usually the last to fall. And this is just for the interested. This is the broader trend on the LEI index since 1980. So you can see it has pretty routinely predicted every recession that came up. Now, obviously, there's some false flags in here as well, so it's not perfect, but it's a very very strong indicator of what's going on in the underlying economy. Unemployment obviously has picked up. You can see we've had a rise in unemployment, but what I really want to talk about is we'll get back to this. What I really want to highlight is this. So this is fascinating. So this is the valuation of the US stock market today. The It has not hit this level. I mean, I think the last one was 29, and obviously it was fairly overpriced before '08. So this is the thing that is propping the LEI index up right now. This is propping it up. And eventually valuations need to revert to norm to catch up to what the underlying economy is doing. So I wouldn't want to be a stock market investor right now. I'm not a stock market investor. And interestingly enough, real estate is in a bear market right now, and the stock market is very much in a bull market right now, arguably in bubble territory. A little bit driven by the Fed, right? There's a lot of trading on the stock market driven by what the Fed is going to do. But if you compare the two asset classes, I'd much rather be in real estate right now, buying real estate, not necessarily owning it. Now's a good time to buy it, I think. But this is holding up the LEI index. There's another look at it, right? So here's pre. This is 99, the tech bubble. Here's before COVID, and here we are today. And I mean, these numbers are somewhat alarming if you are thinking about what's going on with the broader economy. And then lastly, to go back to the Tricolor Holdings thing. So this is from Moody's. They basically are saying the 1 year expected probability default for US public companies is at an all-time high. So their estimate is that companies' balance sheets and debt are really bad. And why? Because they took on a lot of debt in the last decade at very low rates. And just like the US government, just like the British government, we all got to refinance our debt at some point, except now it's very expensive to refinance that debt. So all of these companies that are here on a valuation perspective also need to like double, triple their debt burden right now, which is fascinating. So fascinating and terrifying. So I'm not calling for a recession, but I think the indicators based on the research that our team has done here on this, and this is available on our website, are alarming. And there's some indicator that something bad is coming
Yeah.
down.
So that's the Timeless Investor on Substack, yeah?
Correct. Yeah, that's
Yeah.
our home
Yeah.
base, if you will.
I saw something last week or the week before about how the top 10% are responsible for 50% of consumption related not emissions, but this is the wrong article I found here. But in the US, yeah, the top 10%, the wealthiest, they yeah, they do like 49.4% of all the consumer consumption.
Mhm.
And they have a lot of wealth in the stock market. So you could argue if the stock market corrects, they're going to feel a lot less wealthy. They're going to consume a lot more.
Correct.
That corresponds to that leading indicator number. And it's weird because I've known about the leading indicator for years. When I worked in the markets, we followed it, but for some reason, the markets don't follow it that closely. They follow more the jobs number, which doesn't seem to be as
Just a lagging
reliable. Yeah,
lagging indicator because
yeah,
companies don't start laying off until they absolutely have to, right? So
yeah,
job numbers are a lagging indicator, yet it's what everyone focuses on. But the LEI has really powerful predictive
yeah,
capabilities. What's going on? Because it would be weird for the LEI to be rising and us to be going into a recession. Like the components of the LEI. And one of the things we did often in research, and I would encourage everyone to do, is anytime anyone quotes an index, go look up the components of it. Like we quote CPI all the time, but how many people have looked at like what's the components of the CPI? Or,
yeah,
we used to do that at Fisher all the time. They'd be like parse the actual numbers, like get into like what it actually comprises this index. And if you look at the LEI components, and I don't have them on immediate recall right now, but if you look at them, it would be a really weird environment if the LEI was rising to go into recession. But you can see why if it's declining, it could mean something. And consumer expectation sentiment surveys have some predictive power because if people feel bad about the future, they are going to not spend. They're going to start saving and preserving and protecting themselves, which has a self-reinforcing effect as well on the market. So I hope I'm wrong. I would prefer not to be right, but yeah, the signals are not good right now.
Ari, thank you for your time, and yeah, I urge the viewers to subscribe to his channel, The Timeless Investor. Also look at the what's the is also Timeless Investor on Substack.
Timeless investor on Substack. Yep.
Okay, great, and we'll keep in touch. And yeah, nice speaking with you.
You too, Mario. Thank you for having me, and thanks everyone for listening. Appreciate it.